All righty. Hello, everyone. Today, I have the pleasure of having Darius Dale to come and speak with me. And Darius runs a firm called 42 Macro, where he does a lot of really good research. And I think that people who know me and know how I approach the market are like, why are you talking to somebody macro when all you ever tell us is that macro is the single biggest destroyer of making money in the markets that there is, which in a way is something that I believe. But I'm here to say that the reason that I like 42 macro is because Darius realizes that he uses the market itself as one of the best indicators for what's going on with the macro. And that's why I like it, because that is how, in my view at least, you should approach macro. There's no better macro indicator than the market. Okay, because the market sees the future much better than you ever will, right? It is the discounting mechanism. So, and Darius, I believe, is one of the few people that I've spoken to that do macro that understands that. Most of the macro people want to say, well, there's going to be this and the market's doing this, therefore I'm going to do, there's going to be a recession and the market's on highs, therefore I'm going to short the market. It's giving me a gift here. And that's when I come in and say, macro is horrible. Okay. But this man does not do that. I read his stuff all the time. I'm lucky that I get it in my email box. And I think that what he does is great. So anyway, that's my little intro to the man. Welcome.
Jason, that is a super kind introduction, and it couldn't be more accurate. I share your concern about using macro as the primary tool for approaching investment markets. In fact, I would argue the average investor probably shouldn't use macro at all. They'd be better off just being long an index fund, at all times. Now, I don't think that's an appropriate way to invest either. However, I do think that, if you do macro appropriately, which is, what we find and our clients around the global Wall Street are doing, if you do macro what we consider to be appropriately, then you can actually add value to a portfolio or client portfolios. So, Jason, you mentioned, real briefly, I'd like to hit on kind of how we think about doing macro. That's, in our opinion, quite a bit different than what most folks are consuming on Twitter to help, kind of embellish the point you're trying to make, which is I don't think that investors are listening to the market enough. And so, one of the most sophisticated tools that we've built for our clients here at 42 Macro is our global macro risk matrix, and it allows us to nowcast the market regime. Now, why does the market regime matter? Why does that matter? Because the market regime is what dictates the dispersion within and across asset markets that we as investors experience in our portfolios. Do I want to be long small caps or large caps? Do I want to be long high beta or low beta? Do I want to be long bonds or stocks? Do I want to be long gold or the dollar? Those types of things are a function of what the market is trying to price in. And so historically, there have been 4 different economic scenarios that the markets are trying to price in. And what we've built our market regime nowcasting process to do is to identify inflection points in that process, in that sequence. And so if you think about Goldilocks, what's Goldilocks trying to price in? Goldilocks is trying to price in a situation where growth's accelerating or perceived to be accelerating, and inflation's decelerating or perceived to be decelerating. Reflation's where the market's trying to price in a scenario where growth is accelerating and inflation's accelerating or perceived to be accelerating or surprising consensus to the upside. Inflation is essentially the opposite of Goldilocks, and deflation is the opposite of reflation. And so as you can see here in these back tests where we are organizing the performance of the S&P 500 and the performance of Bitcoin across those 4 different regimes, isolated between the risk-off regimes and the 2 risk-on regimes, what we see is that 97% of the market's return has come when our market regime nowcasting process has identified we're in a risk-on market regime, whereas only 3% has come in a risk-off market regime. If you look at this in crypto, it's 109% of the return has come when the market regime is saying we are risk on, i.e. we're in Goldilocks or reflation, versus minus 9% of the cumulative performance in Bitcoin since the exception of the asset class has come when we are in a risk off regime, which means Bitcoin goes down when our market regime nowcasting process says we are in a risk off market regime. And so the number one thing we do, and I'll shut up and let you ask me the question, Jason, the number one thing we do for our clients at 42 Macro that is very different and very counter to how the average person approaches macro, even including the macro gurus or quote unquote gurus out there on Twitter, is we help clients identify and position for the market regime. Everything else I say, where's growth headed? Where's inflation headed? Where's liquidity headed? Where's positioning? All this other stuff is literally just to help our clients emotionally prepare for regime change, so that when regime change occurs, they feel confident in making the appropriate pivots in their portfolio in factor long short terms or in asset allocation terms. So let's say, hey, we're in Goldilocks now, do the Goldilocks dance. So as opposed to fighting the Goldilocks dance, they've been well abreast of our fundamental research views or our other quantitative toolkit that would suggest that Goldilocks is a high probability regime. It should persist for 1 to 2 to 3 months or quarters. But at the end of the day, we don't really care about the forecast. What we care about is what is happening, what is the market trying to price in, and participating in that. And that's how you make money as an investor.
I love it, man. I really do. I love
Appreciate
that
you.
you do it. I think that, like I said before, you say the Twitter macro guys. I mean, that's a whole nother level of just ridiculousness, obviously.
I love it. I'm so grateful that they exist, Jason, because we get to compete against them. This is where the source of our alpha comes from, is the fact that them and their clients are on the other side of our clients' trades and my trades. I use my macro process. We use our macro process to manage my entire liquid net worth vis-a-vis our KISS portfolio construction process. And I'm glad the macro gurus on Twitter are on the other side of my trades, because our trades have been working for quite a long time.
I mean, I can't even really call the people macro gurus on Twitter. I would call the people like on Wall Street, even making fun of them macro gurus. The people on Twitter, I just think are Twitter morons personally, but whatever.
I won't go that far.
There's a whole psychology behind this whole thing. I think, I really have I was never involved in any of this stuff. I was never even on Twitter until a few years ago. But yeah, the psychology of gaining followers, is obviously you have to appeal to the masses, and the way to appeal to the masses, as we know in politics as well, is to present the least common denominator, So it's almost like with that stuff, and as we know, as you have talked about, we have talked about, we've exchanged comments on Twitter about this. The number one thing, if you want to do that, just be bearish. Be bearish. That people love that stuff, man. They love it. So be bearish, get a ton of followers, and then just keep justifying it the whole way, right? And people love it, and that's great, because, like you say, it's great that they do that, because it allows us to make money.
100%, man. You and I talked about this in our program last year, and I'll get you back on when we have the next opening. You nailed this. You said that there is a psychological, emotional response to shorting the market and being right that it causes investors to be addicted to. And I've seen this throughout my career. I've obviously flying around the world, circumnavigating the world, meeting with institutional investors. We obviously observed this on Twitter, which is this sort of, I would say it's sort of like a beauty pageant of bear porn, if you will. Who can be the most bearish for the most bearish reasons, with the loudest tweets and or podcasts, titles. And ultimately, you forget that the game out there is, again, to your point, it's about growing It's about growing the community, the size of the community. It's about generating clicks, generating newsletter subscriptions, and ultimately that makes the person who purveys that bear porn quite rich. But in our opinion, what we're trying to do for the world is democratize credible, proven quantitative techniques that allow people to take advantage of macro in a way that generates positive returns in their portfolio. I don't think we've got the whole the investing thing figured out. I've been some words about that. We certainly don't have everything figured out, but what we do have figured out relative to our competition is that negativity bias does not win. You do not make money as an investor constantly shorting raging bull markets. You make money as an investor participating in raging bull markets, and just that fundamental thought there, as different as it sounds, as it should sound different and feel different to investors who are generally sort of communicating with folks like us, talking heads like us, people who you listen to talk but never see their feet. That's kind of a new industry if you post-COVID, but we're grateful to be part of that industry, because at the end of the day, we are democratizing some of the best aspects of institutional finance around the world for Main Street, and I'm really proud of that. Having been someone who grew up on Main Street.
I love it. And it's funny you say you grew up on Main Street.
I wish I grew up on Main Street. I actually grew up homeless, but that's neither here
right on the other side of the tracks of Main Street. But my point is, the point I was going to try to make is, I truly believe this too, because you came from a different place than where most of your Wall Street people came from. You have a much more open-minded view of how the world works.
100%.
And I think that's such an incredibly important thing in this world, and you have the balls to take the different view, and that's what you have to do, and you're independent. So, most of these people I find have to, in a way, agree with each other, because from a career perspective, there's no downside to agreeing with everyone else. The downside to your career is if you disagree with everyone else and you get it wrong. Okay, there's upside. You disagree with everyone else, you get it right, you're a hero, but they don't want to be the hero. They make a nice living, much more than they ever should. So if they just continue to agree with everybody, even if they get it wrong, it's okay, because everybody else is wrong too. Just like they were wrong on this whole bull market, right? We've talked about it when we spoke back then. They were all bearish, right? At the beginning of 23, right? The recession was coming, and they were all bearish, but it's okay, because they were all there. And I hear people say that all the time when they're confronted with that idea now. Well, we weren't the only ones. Okay. So that makes it okay. So you're just as much of a loser as everybody else. So my point being, another thing that I really like about you and what is reflected in your work is that you were A, independent, so you don't fall into that trap, right? And B, yes, you come from a place that is different than where most of these people came from. And therefore you can have a much broader world view. And look, I came from there. Okay. I was an upper middle class kid, man. You know what I mean? Just like all these other guys and all these kids that I grew up with, they went right into Wall Street. I had to rebel against it, which, trust me, I did.
What caused you to rebel, if you don't mind me asking?
What?
What caused you to rebel? Why didn't you just...
I don't know, man. It's a question I get from my shrinks and my wife and my kids all the time. Why?
Shrinks.
Yes. I mean, why? But I really don't know why, I really don't know why I was born that way, but for whatever reason I did, against everything. I mean, getting kicked out of schools and not listening to any adult, you know what I think it was? I said this to someone the other day. I think that I took to heart the lyrics in rock and roll songs for some reason. And I lived that way. You know what I mean? Rebel and don't listen to your teachers and smoking in the boys' room. Smoking in the boys' room was my favorite song when I was in first grade. Okay.
Well, you are so Gen X, my friend.
My mother tells that story all the time. But why was that? I don't know why, but it's what I did. And so therefore I was able to sort of, I think, break out of this group think type of thing because of that. But
look, yeah. I'll give you an anecdote, and I'm sure I can say this now. This is 11 years ago. I was personally fired by Louis Bacon for being too bullish in 2013. Yeah. Personally fired by Louis Bacon, the head of More Capital. I guess More Capital doesn't exist anymore, but one of the world's largest macro funds for being too bullish in a year where stocks were melting up and crypto was melting up. And the lesson I learned from that, obviously, I don't want to do the Schadenfreude thing and make fun of the firm that went under, but this is not the point of the statement. The point, well, I won't join you in that, but the point of the statement is that's what gave me confidence in my career as this outsider entering this business back in 2009, not knowing much my butt from my elbow, but ultimately having to develop process and ultimately figure out what works and what doesn't work. Kind of by myself and not realizing and having the confidence to know that I could get the market right. And this sort of quote unquote titan of finance, this legend, this legendary quote unquote macro trader can be on the opposite side of my trade and actually be dead wrong. That gave me the confidence to continue doing what I was doing, which is develop a process that allows me to listen to the market, to respect the evolution of the market regime.
Such an important aspect of it. Listen to the market, man. Think whatever the hell. Look, I love macro talking about it. I find it very fascinating. Macroeconomics was always my favorite subject. I like to read this stuff. I like to listen to this stuff. I find it extremely fascinating. It doesn't affect my trading one iota. Mm-hmm. Not one. None of my trades have anything to do with what I think is the macro view.
Same.
Right. No, I know, which is why it works. The market is what tells me what to do, not my thoughts on the macro. I can acknowledge I cannot predict the future.
Totally.
You know what I mean? So that's what's so important. Why I think that your work is so good. And again, I think it goes back to some deep psychological shit based on the fact that you didn't come from this type of place where you're rewarded for that type of thinking. I mean, you guys got to understand, this is a man that came from nothing and is a huge success. Went to Ivy League colleges, you know what I mean? Kicked ass on the football field and has kicked ass on Wall Street. And this is not some, I don't want to make it about religion. I'll say it just because I'm Jewish. This is not some Jewish kid from Livingston, New Jersey who went to, Wharton because his dad went there. And trust me, that's who I grew up with. This is a guy who did it himself, man, and therefore has, to me, the legitimacy and the cred. Okay. And he didn't do it by copying everybody else. He did it by coming up with his own thing. And to me, it's just that alone is worth paying attention to in my crazy view. Call me crazy, but to me, that's a fact.
I appreciate that, but I will say one thing. I'll say two things. One, I think you and I would both agree. You don't, just because you sort of grew up, whatever part of the distribution you grew up in doesn't necessarily guarantee the outcome, right? You still have to put in the time, the effort, and make the networking connections to get yourself far in life. Secondarily, I would say is, I wouldn't mince words. We certainly didn't invent everything that we're doing here at 42 Macro in the context of risk management. We stand on the shoulders of giants here at 42 Macro. All throughout our research, you're going to see elements of what works on global Wall Street. There's regime segmentation, which obviously Dalio invented back in the 70s. There's Bayesian inference, which Danny Kahneman and Amos Tversky brought to Wall Street back in the early 2000s. There's volatility as a leading indicator for price change and regime change in asset markets, which is something that Ben Molbanda brought to Wall Street, go back into the late 70s and early 80s. A lot of what we do is learn the proven quantitative techniques and reorganize the proven quantitative techniques in a way that actually makes sense for me and our clients. And so, I will say, as awesome as our research is, I don't think there's anything new under the sun when it comes to, forecasting asset markets and forecasting the economy. What matters is how you construct those things and put them together. And ultimately, I think we've constructed them in a way here at 42 Macro that generally produces superior results relative to the alternative. And we're really proud of that.
All right. So let's get into it. What now?
What now?
Where we go? What are the spoos doing in the next 3 hours? No.
Next 3 hours, I have no idea. I couldn't even tell you the next 3 days. One of the things that I think we do, that really helps our clients, I think we try to keep them abreast of the medium-term trends. And one of the ways in which we do that in terms of helping them prepare for regime change is using our fundamental research teams. And so, our fundamental research teams are, broadly speaking, generally bullish. We have 4 themes right now actively. Our sticky inflation theme is the only one that is, relatively bearish for asset markets. The other 3 are resilient U.S. economy theme, which we authored in September of 2022. Our Jay wants a soft landing theme, which we authored on November 2nd of last year. And then our Here Comes Liquidity theme, which we authored last month. Each of those themes suggest that we're likely to have much higher prices in asset markets over a medium-term time horizon. Now,
hold on, let me interrupt you there if I can. The only thing that's bearish for asset markets on your thing is that you think that there's going to be inflation.
Yeah, sticky inflation. Absolutely.
Sticky inflation.
Yep, correct. It may not result in negative asset prices, however.
Right. Like, to me, why, and it's not that it couldn't, but why is sticky inflation bearish asset prices? Sticky inflation means to me that asset prices are going up. Inflation is defined by asset prices going up.
Well, we're talking about sticky reported inflation. And so it's our view that we have
which obviously could be bearish stocks is what you're saying.
Right. But, exactly. If the Fed takes an adverse response to sticky inflation developments in the economy in the coming months, then we're probably likely to have a significant repricing of the forward rate curve, which could cause a significant repricing in the bond market, which could cause a decline in U.S. and global liquidity vis-a-vis a strong dollar. So those are the kinds of linkages that we're constantly being abreast of and constantly monitoring to see if we're about to start heading into this. Right. This is why we do fundamental research. Going back to this slide here, we do fundamental research to help clients prepare for regime change. So that if we did see a breakdown from the current Goldilocks regime into one of the 2 risk-off regimes, either inflation or deflation, inflation would obviously be the result of the sticky inflation theme becoming dominant in the minds of other investors. Because again, that's what matters is we're trying to predict the activity of other investors. If other investors decide sticky inflation is more important than resilient U.S. economy, Jay wants a soft landing, and here comes the liquidity all at once, then we're going to an inflation market regime. And that's why we're doing the research, so that when we go into an inflation market regime, clients feel comfortable letting go of the previous Goldilocks regime and participating in the inflation regime. They don't have to do that. But guess what? If you're an institutional investor, which half of our clients are, you have to do that if you want to stay gainfully employed and making money on the buy side.
Beautiful. Well said.
So is anything in those things you want to unpack?
Well, I mean, take me through, like, just basically you think we're in a regime right now that's positive, right?
Yeah,
We're
correct.
sort of in the Goldilocksy type of thing right now, right?
Correct. We are in a Goldilocks market regime. And going back to this back test, Goldilocks is where the bulk of the market performance comes, when
Right.
you're in the market
So
performance.
this is not a time to be short. But where we're going to change our mind is if suddenly inflation becomes very sticky.
Well, no, I'll add one small like phrase that statement you make. So it's almost yet. It's what will change. What will change our mind is the market regime now casting itself into inflation because inflation becomes a dominant theme across the minds of the rest of the world's investors. What
And
we're
because
trying to
that
do,
regime, as you could show back on that other chart, is not good for, right.
yeah,
But
exactly.
it's not when you get good returns during that regime.
And the inflation regime. No, it's one of the worst regimes. I mean, the Sharpe ratio basically gets more than cut in half. It's only a quarter of what it would be in Goldilocks, and obviously only 6% of the market's performance since January of 1998 has come in an inflation regime versus 55 and 43% for the two risk on regime. So you're talking about having to make a significant asset allocation and portfolio construction shift if you went from Goldilocks to inflation. And so when that happens, if and when that happens, it may not happen. If and when that happens, we'll know exactly why and have the confidence to make those pivots in our portfolio to stay on the right side of market risk. And that's
And
what
what is the telltale sign that that is happening, if
the
there is?
telltale sign that it's happening is through the lens of our market regime nowcasting process. And so we use our global macro risk matrix as the primary tool to nowcast a market regime, which we believe that you have to position for if you don't want FOMO in a raging bull market or you don't want to get blown up in a raging bear market. You need to stay on top of the market regime and do what the market regime is telling you to do at all times. So how this process works is we're studying the volatility adjusted momentum signal across the 42 most, what we consider to be the 42 most important markets in the world that have the most signal for, explaining dispersion within and across asset markets. And so we do this through the lens of equities, volatility products, commodities, currencies, and fixed income products, rate spreads, et cetera. And how this model works is we are scoring each of those markets in the context of how the market is historically traded in the context of those regimes. So right now, for example, the S&P 500 is bullish from the perspective of our volatility adjusted momentum signal, which, as an aside, means that you have a 96% upside capture ratio in the stock market if it's bullish. So that's just this is a scenario where the market typically gathers most of its bullish momentum is when our volatility adjusted momentum signal has identified as bullish. That bullish characterization essentially is contributing 1 point to both Goldilocks and reflation. It doesn't know if it's Goldilocks or inflation in isolation, but it knows that because I'm bullish, the markets must think it's Goldilocks or inflation. The stock market, U.S. equity market, must think it's Goldilocks or inflation. So we're doing that same process every single day across each of these 42 markets and tallying up the sum, and whatever sum has the highest number and highest share is the market regime. So right now, Goldilocks has 26 of those total markets confirming it. It's the highest share of the total. And so we'll say, hey, we are in a Goldilocks market regime, put on the Goldilocks portfolio, or at the bare minimum, if you're not following along as an institutional investor, to a T, then at the bare minimum, you need to stop doing the previous regime stuff, right? That there's two decisions to make. Do I do more of the previous regime stuff or do I do less of the previous regime stuff? And then do I do the new regime stuff or do I not do the new regime stuff? And that's where the fundamental research comes in. Do you have confidence in the sustainability and the durability of a Goldilocks regime? Or is this potentially a head fake? We see head fakes all the time in raging bull markets where you have like a regional banking crisis in 2023 or a slight risk off regime going back to September, October of last year. But those things are head fakes. And in the context of a longer term trend, you can have confidence to buy the dip once you get the signal to buy the dip in a bull market.
And again, it strikes me as you're using the market itself
100%. It's
as
all the market.
what's helping you define what regime we're in, which I just can't say enough of how important that is, at least in my view. You know what I mean? The market tells you. You don't tell the market. The market is telling you where you're at. Okay, the market's telling us where we're at. And this works when we're at that place. So let's go ahead and do that.
Oh, yeah, 100%.
And let's watch for when the market is no longer telling us that that's where we're at. And then therefore, then we'll know when we need to switch.
100%. And we refresh all these models daily, right? Like that's to me, that's the job of an institutional investor. And the number one thing that institutional investors do that retail investors don't, or the thing that I notice the best institutional investors in the world doing at the firms that we all respect and the PMs that we all respect at those firms. The thing that they're doing that's different than the average investor is they are heavy on observation. They're doing the same things over and over and over and over and over and over and over again, so that when they spot critical inflections in the time series that matter to their positioning, they make a change. They're not constantly trying to predict those things over and over and over again. They're observing them over and over and over again. And when you have a phase transition in asset markets, i.e. through the lens of our global macro risk matrix, or they have a phase transition in, the company sales forecast that they're monitoring, or the company earnings forecast that they're monitoring, or the actual changes in their risk management systems that they're monitoring, that's when they do something different. And so it's my job to do for our clients, and I'm grateful for, is to refresh all these models on a daily basis, report the output, and when something changes, we signal the change. At some point, we're not going to be in Goldilocks. And the proper trade recommendations generated by our Dr. Mo discretionary risk management overlay, which helps our institutional investor clients to time markets and position and guide their position sizing. Eventually, it'll start saying something different. If we went into an inflation regime, it won't say long max position SPY. It'll say short max position SPY, right? That'll be the difference. And so getting that signal in real time is in my opinion, that's how you stay on the right side of market risk, is responding to cogent signals in real time. Again, notice I didn't say predicting cogent signals in real time. I said responding to cogent signals in real time. Most investors, and this is something I see on Twitter as well, Jason. I'm sure you see this. You probably see it more than I do, because I spend probably less time on Twitter, if only because I don't have enough time. I'm constantly doing this kind of stuff.
No,
it's a yeoman's work. I'm not gonna. It's hard, but I'm happy to do it for our clients because we're adding value. The thing that, going back to what most investors are doing on Twitter. What I can observe very clearly every time I turn on Twitter, I see this in my home stream. I spend about 2 minutes a day, just not even reading, but glancing through, my home stream. What are people saying on Twitter today? What are people saying on Twitter today? When I'm on the schneid in the morning in the bathroom. Every time I see people predicting new regime change, new trends, new critical inflections, it's the 99% of people's tweets is predicting change. Most of the time, change does not occur. Change occurs very infrequently. In fact, if you go back and look at our market regime nowcasting process, only 2 to 3 times per year will you have a meaningful enough transition in the market regime to actually do something about. So if you think about this in the context of a raging bull market, that's 1 correction, 2 corrections. If you're in the context of a bear market, that's 1 dead cat bounce and another dead cat bounce. That's typically what happens throughout the course of the year. Yet the average investor is constantly predicting regime change in every which way and direction. And at the end of the day, in my opinion, that's a dangerous thing. It's better to be the second investor in a confirmed trade than the first investor in a trade that never gets confirmed. That's how you lose a lot of money.
Nice. I love it. Confirmed trade. It's one of my mantras.
Oh yeah, absolutely.
I mean, just for the record, if I spend time on Twitter, it's for the same reason that I sit here all day and I have CNBC on and Bloomberg TV on and all that. And it's really because I'm not very smart. And so, but what I can do, because I've been doing this for so long, and because I've done a good job of keeping records and I have a good memory about my trading and all that, is I can recognize in others when they're making the same mistakes that I have made in the past.
Oh, yeah.
So when I see a whole bunch of people making the same mistake that I made when I was a younger trader and thought I was smart and thought I could do macro and thought I could predict the future, it increases the odds that fading that is going to work, right? I mean, we have a saying here, don't trade, fade, right? So in other words, I'm not trying to put on the smartest trade in the world. I'm trying to find the 10 dumbest trades in the world that I can recognize because I've made them in the past and just do the opposite of that. That's what has worked for me. So that's why, I sit there and I monitor Twitter and stuff, because it's just a great resource for finding people that make these same type of mistakes, and I'm not ragging on them. They're human beings. Totally. I've made the same exact mistakes because I am also a human being, right? That tries to think and tries to do all these things. So, but what I found was it doesn't work. It loses your money. So if I can just, I don't care. I always say, who cares about being right? Just freaking make money, right?
Those are 2 separate things.
So that's kind of why I do and monitor the Twitter thing.
No, I'm glad you do, man, and I'm glad you exist, because you're doing in my opinion, in the context of finance, which is not really much in the context of humanity, but in the context of our industry, you are doing the Lord's work. You are trying to help investors stop making the same kinds of mistakes that cause them to lose money and delay their retirement. That's the number. We're effectively doing the same thing, just in our opinion, in a different way, with a top-down market sort of lens. You're
Yes.
looking at this from a positioning cycle lens, but it's winding up in the same place, which is don't do this. This doesn't work. Don't do that. That doesn't work.
No, it's funny
Something
because I think you got into this a little bit earlier with the Louis Bacon thing and all that. But what I find, I knew this a long time ago, but especially if you're trying to be like super contrarian and all that, the more right you are, the bigger jerk you are. If you're super contrarian, if you're telling people what they don't want to hear, that's one thing. They can argue with you. They can tell you you're a moron. They can get all their anger out at you and all that. But if you end up being right, well, now you're the enemy.
I was the enemy.
You know, I've had that my whole life because that's really all I do is which way do I think the market's going? Well, which way do you think the market's going? Oh, you think it's going up? Okay, I think it's going down. It's that simple. That's basically my analysis, right?
Yep.
And then if I'm right, well, then I'm the jerk. I've had that my whole life, and it sounds like something similar to what you were talking about before, which kind of makes me laugh. And it's ironic when it comes to marketing and when it comes to attracting, people. Well, it's ironic. Being right is not what gets you people, right?
No,
appealing to their need to be part of a group is sort of what attracts you. There will be people who actually are interested in making money over time, who will be attracted to things like what you were doing that help you make money over time. There are people, but the vast majority won't. The vast majority want their hand held. Hey, I'm losing money, but it's okay because so is my boys and so is my group. We're all losing money together, so it's okay.
100%, Jason.
Which scares the crap out of me, but whatever.
Well, look, it's their prerogative. Like, people don't have to make money in compound returns, right? Like, at the end of the day, it's your job. If you want to light money on fire and just to be proven, have a thesis be proven right, quote unquote, right, that's fine. But we're in the business of making money. A lot of folks are in the business of being right. And those, in my opinion, are two incredibly distinct things. And I don't know that the average investor, until they've lost a lot of money, either by shorting a raging bull market or by, being a perma bull in a raging bear market, until they've lost a lot of money, they won't realize that. And unfortunately, the problem, what we're trying to do at 42 Macro, which is incredibly unpopular, is to prevent that outcome before it happens. What is popular is what you described, which is we're all losing money together because we're all bearish and shorting the raging bull market, or we're all losing money together because we're all perma bulls and long the raging bear market. That's not what we're trying to do here at 42 Macro. And I can tell that it's not popular. Now, I've been on Twitter we started the business 3.5 years ago. I'm still sub 100,000 people on Twitter. I could care less. I really don't. It does not matter to me one bit how many Twitter followers I have. But when I look at the growth of the accounts that do the exact opposite of the stuff that we're telling people to do here in this conversation, you see that it's 500,000, 600,000, million plus. There are way more people who want to be right than there are that want to make money. But we're really grateful for the ones that have chosen us to make money alongside us because, Lord willing, I really do believe this. I think we have the lowest attrition in all of, if you put a bucket me in the newsletter business, which I would argue we're very much not in the newsletter business, we're in the risk management business. We provide risk management overlays to hedge fund investors. But if you want to bucket us in the newsletter business, we are in the low single digits of annual attrition. And we're really proud of that because we're doing our job for our clients. And so
that's what I have kind of found too, is that while you may not attract the masses by doing, let's call it the right thing, you are going to attract people that are going to stay because they're going to like you for the right reasons.
100%. That's me. That's the right way to grow any business.
It's worth it, to me. It's worth it. And over time, that will only grow. And all good things take time to grow anyway.
Oh, I'm not. We are very blessed. I have no qualms about our growth, our size of our business. Nothing. We are right on schedule. However, to me, I think it goes to sort of I'm a Christian man. I have Christian principles. I think it's more important to do right by my clients than it is to grow my business. And I think
one will do the other over time anyway. So that's the beautiful thing about it. Do right by your clients. You're going to grow your business anyway. So
bingo. And
I think that's the beautiful thing about it. At least I have to believe that. I do see people that do wrong by their clients and somehow manage to grow their business as well. But that's for them to deal with and them to sleep on, them to.
Here's how you grow your business the fastest in this industry. If you want to bucket us again in the newsletter business industry, you tell people there's going to be a market meltdown or melt up. Just make sure that the word melt is in all caps.
Right.
You tell people that if they don't do something, they're going to severely regret it. And the only way to figure that the something is out, they have to subscribe to your
of course.
I've
And
seen
that's
this with
funny
my
too.
own eyes
That
up
always
close and
cracks me up.
personal, and it's very successful.
It's always either melt up or meltdown. There's no in
You got
between.
to use the word melt in all caps, though. That's how.
There's never an in between with anything. The market's either going to melt up or melt down. It's never just going to be normal, which is what it is 98% of the time.
100% of the bingo.
I love it. I love it. So can I ask you what you think? And as I'm learning more and more about what you do, this probably isn't that relevant to what you do, but I'm going to ask you anyway. What do you think about the China situation here?
Oh, we're quite bullish on China. We've been up the view, and I can walk you through a few slides to kind of explain that. That'll be a little bit more sexy than just looking at myself talk here. Although I am a pretty handsome guy, as determined by both Hinge and Yale, the Yale rumpus and Hinge, but that's neither here nor there. So if you go and you look at what's happening in China, obviously they're accelerating liquidity. It's our view that so one of the things that we do for our clients at 42 Macro is we help them stay abreast of all the puts and the many moving parts in the global liquidity cycle, and there are quite a few. China is one of the key sort of contributors to global liquidity. What we've shown on this chart here is our China liquidity proxy. That's the aggregated sum of the PBOC's balance sheet, China's broad money supply, and China's FX reserves minus gold. All those things are contributory to liquidity for various different reasons. And then we have a bond market volatility overlay to simulate the impact of the repo market. China's liquidity impulse had declined from a pretty significant positive flow in the first part of this year to a significantly, kind of very muted flow. Over the past couple of months, it kind of started to pop back up again. And in the next sequence of months, it's going to pop up, more materially as a function of the most recently announced $500 billion package across, roughly $250 billion of monetary support for the economy and for the stock market, and another roughly $250 billion of support for the economy. We suspect we'll get more, but that's neither here nor there. The reason we suspect we'll get more is because what they're doing now won't work. And what they're doing now not working, the option is, okay, it didn't work. We're just going to slide into the abyss economically, or we're going to do more of it. And that's our view that they will eventually do more of it. And so we don't want to be on the wrong side of that as an investor. So if you look at this chart here, there's three kind of core factors of why we think China's, in or sliding into a balance sheet recession that is causing Beijing to, aggressively, sort of ease monetary and fiscal policy. One is excessive debt. If you look at 205% private non-financial sector debt to GDP, that's as high as it's been. That's as high as it was in Japan prior to their balance sheet recession, which is the kind of most crystal clear example of a balance sheet recession that we have, other than the post-GFC U.S. economy. Number two, we have evidence of capital misallocation at 42%. China's investment to GDP ratio far exceeds what Japan did in its previous real estate bubble, which is obviously what China has had and has been dealing with for the past 10 to 15 plus years. And then finally, we have a shrinking labor force. If you look at the slope of China's old age dependency ratio, which is the share of the population that's 65 and older divided by the working age population, the slope of their old age dependency ratio is significantly higher than the slope of everyone else's old age dependency ratio, which means that the two things are actually happening in China when you break apart the numbers. One, the labor force is shrinking, but also the economy is getting much older, or the population is getting much older. So it's our view that they're going to have to keep their foot, much like the Fed had to keep its foot on the gas, every other year, post 2009, post 2008, the China is going to have to keep its foot on the gas in terms of fiscal and monetary support. And so we think we've hit a secular low in Chinese asset prices, certainly on an absolute basis, but more likely also on a relative basis to U.S. and global asset prices as well. We're not raging bulls on China. We're in fact quite bearish on China as a function of these three forces, but the policy response to those forces are likely to perpetuate positive returns in Chinese assets. But we don't necessarily need you or want you to be long Chinese assets indefinitely because of that view. We want you to be long Chinese assets when our discretionary risk management overlay is telling investors to be long a max position in China, which it pivoted clients into on September 17th. And obviously, we've had a significant rally in Chinese the FXI ETF since September 17th. It's up about, inclusive of today's significant decline, it's up about 22% since then. So that's kind of how we piece the puzzle together for China.
Beautiful, man. Thanks for that. People, 42 Macro, run by this man, Darius Dale, who is a smart guy, who is a good guy, and who is an honest guy. Okay. And how many people have you heard me say those three things about? Quite frankly, he ain't paying me. All right. And he's not teaching me how to sack the quarterback either. Although I think you were an offensive line, right?
Yeah, no, what did that? 38 starts, 0 sacks. That's a phenomenal statistic.
You were offensive lineman, right? Yeah.
Offensive tackle,
So
yeah. Like
he's not teaching me how to prevent sacking the quarterback, I should say. He's not bribing me. He's not doing anything. He is a smart guy. He
I'll
is
give
a
away my
good
secret.
guy,
Pack
and
the
he's an
elbows.
honest guy. Check out 42 Macro, in particular, if you actually like to make money in the
Can,
markets,
can, can
because
I plug you too?
I can say that it will help you.
I appreciate you saying that, Jason. I'm going to plug you too, man, because we've obviously we have a lot of interactions with a lot of different investors, and we have our monthly pro to pro a discussion where we host an institutional investor or an investor like yourself, which I would consider to be institutional investor like yourself on our program. And you said something to me that it didn't change the way I viewed the world, but it certainly solidified how I viewed the world. It gave me more confidence to view the world in the way in which we do, which is, there's a psychological emotional response to fighting the bull market. And it made me realize that, okay, if I really truly want to add value to the world out there, it's to help them overcome that and participate in bull markets. We have a view that we're in a fourth turning regime. We're going to see accelerated monetary debasement. We're going to see accelerated fiscal support for the economy, and we're ultimately going to see financial repression throughout the duration of this fourth turning in a more material way than we've already experienced in this post-crisis era. And so that obviously suggests that you should probably, as an investor, be long things like gold, stocks, Bitcoin, those types of assets, and underweight at the bare minimum things like treasury bonds and the US dollar. And so that's my long-term fundamental belief system. And it's not impacting any of our market regime nowcasting features. But what it's likely to do is keep us in a risk on market regime at a higher frequency relative to the risk off market regimes over a longer period of time. And that's how we translate those fundamental views into actual risk management signals. And so we just want to say thank you for giving me the confidence to better express and sort of pound the table on our longer term fundamental views in the context of our systematic risk management process.
I had some kind of positive impact on somebody like you, man, and that's just great news for me.
I appreciate you. Now you're having a huge positive impact, man. I think you are, like I said, I think you're doing the Lord's work too, man. And I feel that about ourselves here at 42 Macro, and I feel that about you guys at Crowded Market Reports. So if you're a 42 Macro client or somebody in our community, definitely check out Jason's work as well. Appreciate you.
Awesome. Well, thanks, man. I appreciate you getting together with us on this Tuesday afternoon.
Awesome, man.
Always good value. Always good to talk to you. Always good to see you. And where are you? You're in upstate New York, huh?
Yeah, I'm in Saratoga, man. It's gorgeous up here this time of year, man. It's awesome. How about you?
Oh, I'm in Rhode Island.
Rhode Island. Yeah, it's gorgeous over there too. It's a good time of year to be in Northeast, man.
Yeah.
Not in like a month, but we got another month left.
Yeah, we're good to go. Thanks so much for taking the time, man.
Of course, my friend. Of course. Appreciate you.